Ever get that feeling that what we learned about money, maybe in school, it doesn't quite fit the real world?
Oh, definitely. Like there's a whole different playbook out there.
Exactly. Like there's a game being played, but we never really got the rules.
That's a really good way to put it, and it's basically the core idea behind Robert Kiyosaki's book, Why the Rich Are Getting Richer. That's what we're digging into today.
Right. So Kiyosaki, he argues that the wealthy, they operate under a totally different set of financial principles, stuff that's often the complete opposite of common advice.
It's like they have this insider knowledge. His main point is that our standard education, while great for lots of things, really drops the ball on financial literacy.
Like understanding how money actually works, how to make it work for you.
Exactly. It teaches you how to be a good employee, maybe, but not how to build wealth.
And this isn't totally new ground for him, is it? It builds on Rich Dad, Poor Dad, his big hit.
Precisely. Yeah. Why the Rich Are Getting Richer takes those ideas and goes, well, deeper. It looks at the specific reasons why he thinks this wealth gap is growing.
And some of his ideas are, let's say, pretty controversial.
Oh, definite. We're going to unpack some of those today, the ones that really challenge conventional thinking.
So our goal here is to explore these ideas, these maybe paradigm-shifting concepts. We'll look at why Kiyosaki thinks common advice might be, well, wrong for most people.
And we'll try to keep it clear, without getting bogged down in too much jargon.
Okay. And our source material. It's mainly summaries, key ideas from Kiyosaki's book, plus a bit about his overall perspective.
That's right.
All right, let's jump in. This claim that the education system itself is a cause of the wealth gap, that's a big statement. What's his reasoning there?
Well, his argument is that schools focus so much on academic skills, professional skills, getting you ready to be an employee or maybe self-employed.
To get a job.
But they almost completely skip the principles of how wealth is actually created, how money is managed to grow.
He uses his own story a lot, doesn't he? The contrast between his poor dad, highly educated but financially struggling,
and his rich dad, who is more street smart about money.
Yeah.
It highlights that disconnect.
Exactly. His poor dad followed all the conventional rules, worked hard, saved. But Kiyosaki argues that path often just keeps people trading their time for money.
Okay, so that leads us straight into his less popular views on standard financial advice. He really questions the basics, doesn't he?
He really does. Take saving money, for instance. We're all told to save, save.
It's like rule number 1.
Right. But Kiyosaki says, flat out, savers are losers.
Whoa, okay, unpack that. Why are savers losers in his book?
Well, it sounds harsh, I know, but his logic connects to things like low interest rates and, more importantly, currency devaluation. Governments printing money.
Inflation eating away at saving.
Exactly. He often points back to 1971 when Nixon took the U.S. dollar off the gold standard.
Right, which meant the government could print more freely. Precisely. And Kiyosaki argues that this constant printing devalues the currency. He claims the dollar's lost something like 90% of its purchasing power since then.
Wow.
So the dollars in your savings account might go up a tiny bit with interest, but what they can actually buy is going down potentially faster than the interest adds up.
So the real value is eroding. Okay.
Yeah.
Makes sense. Now, what about debt? The other big one. We're told debt is bad, avoid it at all costs.
Yeah, and Kiyosaki flips that one on its head too. This is where he brings in the idea of good debt versus bad debt.
Okay.
He argues that for people who understand it, debt can actually be a tool to get richer, especially when you factor in taxes.
How on earth can debt make you richer? That feels so counterintuitive.
I know, right? But think about it this way. Bad debt is like credit card debt for stuff you consume, things that lose value.
Okay, like a fancy TV.
Exactly. Good debt, in his view, is borrowing money to buy an asset that generates income or appreciates.
Like rent property.
Perfect example. You borrow money for the mortgage, the tenant's rent pays the mortgage, hopefully leaves some cash flow, and the property value might go up. Plus, you often get tax deductions on the mortgage interest.
So the debt is financing something that makes you money rather than costs you money.
That's the core idea. Someone else, the tenant, is essentially paying off your debt while you own the asset. It's totally different from just getting out of all debt, which he connects more to the left side of his cash flow quadrant.
Okay, let's talk about that quadrant. It's super important in his work. Can you break it down for us?
Sure. It's basically 4 ways people earn income. E is for employee. You work for someone else.
Got it.
S is for self-employed or small business owner. You own your job, basically. Think doctors, lawyers in small practice, freelancers.
Okay, the left side.
Right. Then the right side is O for business owner.
Yeah.
You own a system that makes money, usually with employees working for you. Think big businesses.
Right, not just owning a job.
Exactly. And I is for investor. Your money makes money for you through stocks, real estate, other ventures.
And his big point is that where you are in that quadrant really affects your financial life, particularly taxes.
Hugely. He argues that the system is set up to favor the O and I quadrants, business owners and investors.
Why is that?
Because their activities creating jobs, investing capital, are seen as driving the economy. So governments often give them tax incentives, loopholes, ways to pay less tax legally.
Compared to the ENS folks.
Who usually pay the highest percentage in taxes. Their income is mostly earned income from working, and that's typically taxed the heaviest.
So moving from the left side, ES, to the right side, OY, isn't just about changing jobs. It's a whole different financial world.
It's a mindset shift, definitely. Requires different skills, different financial intelligence, as he calls it.
Okay, so if that's the goal, understanding that quadrant, what does Kiyosaki say isn't real financial education? He seems pretty clear on what doesn't count.
Yeah, he is. And some of it might surprise you. For instance, he kind of dismisses traditional economics. He asks, if economics really holds the key, why aren't more economists super rich?
Huh? Fair point.
He also says just learning to balance your checkbook while, basic and necessary isn't true financial education. It's just management.
Okay. Doesn't help you grow wealth.
Exactly. And he hammers home the saving point. Again, just saving isn't enough because of that devaluation we talked about.
Right.
Having a good credit score. Important for getting loans, sure, but he says it doesn't mean you're wealthy or financially smart. Lots of people have good credit but are drowning in payments and getting rid of all debt. Again, he distinguishes between bad debt for liabilities and good debt used for assets.
So that liability versus asset distinction is key.
Absolutely central. He even challenges the idea of just living below your means. He thinks sometimes that can foster a scarcity mindset, making you poor in spirit, maybe missing opportunities.
And what about just putting money in the stock market long term? The classic retirement advice.
He's cautious there, too. He warns about massive market crashes, the potential for huge losses that could wipe out years of savings. He prefers more active control over investments.
Wow. Okay, so if none of that is the real deal, what is legitimate financial education in his view?
Well, he actually says it doesn't need to be super complex. He uses his cash flow board game as an example, learning through simulation.
Right, learn by doing almost.
Kind of. But a core part is understanding the types of income. That's crucial.
Okay. He breaks it down into three main types, right?
Yes. First is earned income. That's your paycheck, salary, bonuses, pensions, money you work directly for. And as we said, usually the highest taxed.
Got it.
Second is portfolio income. This is mostly from paper assets, stocks, bonds, mutual funds. Typically, capital gains from buying low and selling high.
Okay.
Third is passive income. This is cash flow from assets you own that work for you.
Yeah.
The classic example is rental income from real estate, but it could be royalties, other business income you don't actively manage day to day.
And he connects these income types to different financial levels.
He does. He observes that most poor and middle-class people rely almost entirely on earned income.
Right. Trading time for money.
Millionaires often get a lot from portfolio income, but then he introduces this other level for the really wealthy, the money masters, he sometimes calls them.
Okay.
He calls it phantom income.
Phantom income. Sounds intriguing. What is that?
It's a bit more abstract, but basically it's wealth generated indirectly, often through the strategic use of debt and tax laws, without direct cash flow necessarily hitting your bank account in the same way. It's like making money from the structure of the deal itself.
Okay, still a bit fuzzy. Can you give examples?
Sure. Think about real estate again. Appreciation, the property value goes up. That increases your net worth, even though it's not cash in hand yet. That's a form of phantom income.
Ah, okay. Unrealized gain.
Exactly. Then there's amortization. As the loan principal gets paid down, often by the rent, your equity in the property increases. Again, your wealth grows on paper.
Right.
And the big one he often talks about is depreciation. This is an accounting thing. For tax purposes, you can deduct a portion of the property's value each year as an expense, assuming it's wearing out.
Even if it's actually going up in market value.
Especially if it's going up in value. That deduction reduces your taxable income from the property, maybe even creating a paper loss you can use against other income. So you're paying less tax, effectively getting richer, while the asset itself is appreciating. That's phantom income.
So it's about understanding these more sophisticated financial mechanics, especially around debt and taxes.
Precisely. And that understanding, that's what he considers real financial education. It's essential for creating what he calls a plan B.
A plan B beyond just having a job.
Yeah, a strategy to move from being an E or S to becoming an O or I on his quadrant. And that requires this deeper education.
And he says moving quadrants isn't just about money, right? It requires personal growth, too.
Oh, absolutely. He talks about increasing your mental, emotional, physical, and even spiritual intelligence. You need resilience. You need to handle fear and risk. You need to think differently.
Challenge those old beliefs.
Exactly. You need the courage to learn how to use debt strategically, understand tax law, and really step into that business owner or investor mindset.
And the payoff isn't just, pinching pennies and saving.
Not in his view. The goal of this education is freedom, abundance, having fun with it, really, making money work for you so you can design your life, not just survive it.
It's interesting how these ideas sometimes echo other self-improvement or wealth authors. You mentioned a few connections earlier.
Yeah, you can see parallels, like Paulo Vieira talking about the ups and downs of getting wealthy, that need for resilience Kiyosaki implies, or Napoleon Hill's emphasis in Think and Grow Rich on having that burning desire for wealth. That motivation seems key to Kiyosaki's approach, too. You have to really want to make that shift.
Right.
And maybe Tony Robbins talking about associating pain with bad habits. Well, you could apply that to breaking unhelpful financial habits that keep you stuck on the left side of the quadrant.
So wrapping up, Kiyosaki really throws down the gauntlet on conventional wisdom. Savers are losers. Good debt exists. Your house isn't necessarily your biggest asset. The usual advice might be holding you back.
Yeah, it's definitely designed to make you stop and think, to question the financial narratives we often just accept without thinking.
It really is. Which brings us perfectly to our final thought for you, the listener. Thinking about everything we've discussed, all these challenges from Kiyosaki, what's maybe one financial belief or assumption that you hold right now that might be worth re-examining?
It's a powerful question to ask yourself. What foundation are your current financial choices really built on?
Definitely food for thought. If this sparked your interest, absolutely check out Robert Kiyosaki's work directly or just keep exploring these ideas. Thanks for joining us on this deep dive.